you have the baby system flow analysis, and the International Resource Panel is the equivalent of the IPCC, but for material resources. And the underlying assumption is that you can't decarbonize without fundamentally dematerializing the global economy. So that's the thermodynamic argument, which you guys are probably more advanced on than anybody else. In the resource panel, we talk about dematerialization, decoupling as one of the key levers for successful decarbonization. But there's no real economic theory. There isn't even a theory of thermodynamics underlying it. The only real theory that's there is the notion of decoupling. And decoupling, in my view, is just a description of a graph of rising material resource, rising GDP, and these two must kind of separate each other out. But exactly how you do that and the governance and institutional and financial implications of that are not discussed. It's just a kind of wishful thinking. So every report, and there's been a lot of reports on water, on soils, on forests, on metal, lots of reports on metals, et cetera, they always end off. Therefore, you need decoupling. So that's not good enough. So Helga Weiss is a relatively new member of the resource panel. I'm a founding member of the resource panel. South Africa, my country, nominated me to be on the panel in 2007. I think they forgot about that decision because they've never asked me to tell them what I've learned and how useful it is. We suggested about a year ago, maybe more actually, to the resource panel, listen, you need to get into transition theory. So there's a group of modelers from IOSA who are doing the modeling work around what transition could look like from a modeling point of view. And we said, that's not good enough. You need an institutional and governance perspective. And that was approved. But as we moved into it, Helga and I felt we should focus on finance. And then we invited Kyle to join us. So that's really the origin of, so there's a report now, and next week there's a meeting. When is it? The week after next? 2 weeks. There's a meeting in Paris of the International Resource Panel. I'm trying to get confirmation that we are actually on the agenda. I would not be surprised if the co-chairs decided this is too radical and too dangerous to put onto the panel with all the country representatives sitting around the table. We might think the RP is not respectable enough if this is what they're talking about, but who knows? The head of the Secretariat is a South African, so I'm kind of trying to exploit that. So that's the starting point is this quote from UNEP's Green Economy Report, which was a big 600-page report in 2011, mapping out a kind of scenario to 2050. And at the very beginning is this amazing statement. The causes of these crises vary, but at a fundamental level, they share a common feature: the gross misallocation of capital, and then all the other stuff that capital went into and what never happened. The rest of the report doesn't really ever come back to this point. The rest of the report is really just the usual scenario model building stuff, saying therefore we need a different pathway to sustainability through to 2050, and it will also result in greater economic growth if we are more sustainable. So that's the basic logic of the report. But the underlying assumption is, well, unless you bring misallocation of capital to an end, you're not going to achieve any of that. The driver of that is going to be the proper allocation of capital. I can put it that way. But then what does that mean? And how do we understand the challenge? So this is a diagram from the FSB, and I'll just blow up the key numbers, which basically on the top line there shows you that the financial assets of all the public and private financial institutions is $426 trillion in 2020. And that's 628% of GDP. So if you say, okay, what was the value of financial assets in 1950? It would be roughly between 30 and 50%. So what this means is that over, in particular, the last 20, 30 years, more and more capital has gone into financial assets, and therefore not into the productive capacity and productive assets that traditionally has been where finance has gone. So these numbers really is just the best, in my view, starkest representation of the notion that the global economy has been financialized. In other words, the driver of GDP growth has become finance, not the primary and secondary sectors. And the result is the locking up of capital in financial assets rather than in productive assets. But if we're interested in a transition, a whole pile of capital has to go into real stuff in the real economy. But financialization is really very much about the disconnect of the financial system, the decoupling, if you like, of the financial system from the real economy. And that's really the fundamental problem in the world today. Finance circulates within finance, and most of it gets locked up in that space. And I only really realized this because I've been in the finance world now for about 8 years. I'm currently the chair of the Development Bank of Southern Africa, which is a state-owned bank, the equivalent of France's French Development Bank or Germany's KfW. And unlike KfW and French Development Bank, the South African Development Bank doesn't get any cash from government. We have to raise all our own capital off the capital markets, repackage that and put it into development. The more expensive that capital is, the less real development we can do. So, and so that's when I started to realize how much capital, how much finance actually just spins around on itself. And institutions like ours play this kind of it's like the pimple on the back of the elephant. You're just trying to drain as little as you can, or as much as you can from this giant, just to put into something good. Okay? So this is the problem statement that the paper addresses. And obviously it's very nice to have UNEP there because the International Resource Panel is a child of UNEP. And you can't really argue with these numbers. I mean, this is the FSP. So I like these two quotes. Larry Fink, the CEO of BlackRock, who in his famous letter to the corporations that BlackRock invests in around the world, said, "I believe we're on the edge of a fundamental reshaping of finance." And when Mark Carney was the governor of the Bank of England in 2019, a new sustainable financial system is under construction. So the question is, why do people like this at the kind of apex of the public and private financial system start to use this language? So I'm not suggesting this is true in terms of what they mean by this, but it's a reflection that they are trying to in a sense ride the wave. They're trying to catch the tiger and say, well, this thing is going to go out of control. Let's try and direct it in a new kind of way. So this is the flagship report, the Global Resources Outlook of the International Resource Panel. So it's the equivalent, but not nearly as famous as the assessment reports of the IPCC with respect to resources. And what we focus on in the IRP and all the different reports is biomass, fossil fuels, metals, and non-metallic minerals. Water's not there because if you put water, all of that can be measured in tons and put onto a single graph. But if you put water there, everything else disappears. So you can't actually see it on a single table. So you can see everything on a single table with those resources. So 1970, the world was consuming 27.1 billion tons of stuff. Actually, we extract double that, more or less. But that's what we use, okay? So the extraction is double. The other half is the environmental crisis, what you throw away and the destruction that it causes. And 2017, by 2017, it had gone up to 92. So that's the the materialization graph. You can just imagine what the graph looks like. Yes, continuous upward, along with GDP. And what decoupling means is kind of leveling off and maybe going down, but you'll never get to zero, of course. So the demand per annum has also escalated since 2000. So the notion that you will find in developed countries, OECD countries, that there is dematerialization is actually at a global level nonsense, because actually you're just moving material consumption to the developing world. So the average shifted from 7.7 tons per capita to 12.2. High income countries at 27 tons. The middle income countries at 18, low at 2. And so the question then is, from this, when one is looking at these figures, is, well, if you have overconsumption in high income countries, that means you have underconsumption somewhere else, and who is subsidizing who from a resource point of view. And that's basically what the 11.8 billion tons, which is 12.8% of the total, is appropriated by high income countries from the rest of the world. So that really starts to bring into focus, which is actually in this report, incidentally. Subsequent to this report, a couple of us said, do you know what this means? There's no theorization of it. But if you're in the global south, you will have been brought up in your university life, having studied unequal exchange. Because unequal exchange is really the economic theory of development and underdevelopment, which says the rich will get richer at the expense of the poor. Okay. But it's all at a very superficial level. The actual, it's really about market financial flows rather than resource flows. So now we have databases to say, okay, well, now we can actually track the actual quantities of stuff moving. And therefore you can translate unequal exchange into unequal ecological exchange, which is unequal resource exchange. And that's really what this 11.8. And then there was a subsequent debate where people like me said, hey, because the co-chairs were asked by the G7 to write a kind of position paper. And they wrote this position paper, which was absolutely awful. And I took this number out of our own report and said, why don't you refer to unequal exchange? Here's our number. And it triggered a very kind of hostile reaction amongst the academics in the North, saying, no, this is da. So I said, well, why do we use the number? So just a way of thinking about what this means in terms of pathways. There's a very famous Argentinian economist called Galopin, who has influenced a whole generation of thinkers in the global south. And he pulled together this, what I think is a very useful diagram, and it's in the first report on decoupling of the IRP, which I was a co-author of. And what it does is map out useful pathways for thinking about the transition from non-development, which is the first circle, through to maldevelopment, which is the second circle. So that's development where you have development, but it's highly unequal, kleptomaniacal kind of development. Then you have development with material growth, which is the third slice. So this is more equitable, more redistributive construction, more of a middle class. And then you have development with non-material growth. In other words, it's not anti-development, you still have development, but the growth in material, so it's a dematerialization of development, if you like. And then there's the zero growth option, which is, to stop material use, you basically have to stop economic growth. And that's obviously a very dominant way of thinking amongst progressives in the global north, but in the global south, where you have to meet material requirements, it's an almost impossible argument. But what you can mobilize is the notion of non-material economic growth. Once you've gone through a basic phase of development. And there's certain pathways that you can't go through. Very difficult to imagine how you go from non-development through to conventional development in a simplistic way. You have to kind of think about how you go through those transitions. So just to dwell a little bit more on this question of ecological unequal exchanges, is now called in the academic literature, which is facilitated by the global financial institutions. So it all gets mediated and transacted through the global financial institutions, and that really talks to at what point do those institutions take responsibility for that. So if we look at these numbers, which is from Hickel's work, which was published this year, raw materials, between 24 and 43% of resources extracted in the South are consumed in the North. 20% of all land in the South is embodied in goods consumed in the North. In other words, you need land to grow the crops that get put into cans or shipped to the North, or whatever the case may be. 28 to 30% of all labor in the South is actually deployed for the production of goods that are consumed in the North. And 10% of the energy generated in the South is embodied in the goods that are consumed in the North. So this is not financial transactions. These are simply, at a very basic level, what's being produced or used in, say, Ethiopia, which gets consumed, let's say, in France, and as opposed to being consumed in Ethiopia. So that's the resource argument. So from a sustainability point of view, northern overconsumption is unsustainable. So the IRP, during the open working group discussions that led to the SDGs, was asked, what's a sustainable material consumption level? And without much science, we said 6 tons per capita. So, since then, the IRP has decided we don't like a target like that because it makes too many people uncomfortable. But nevertheless, it's there. So that 20, if you compare the 27 to the 6, then you get the sense of what is the level of overconsumption.
What would be the underlying argument below 6 tons?
The underlying argument would be, if you take the IPCC target of a 2-ton carbon world, what's the equivalent lifestyle of living a 2-ton carbon world? And if you correlate that 2-ton carbon world to, say, I don't have a car, I don't fly, I'm a vegetarian, I live in a high density environment, I walk to work, whatever. If you package all of that, and you have solar panels or whatever it is, if you package all of that, you can reach towards a 6-ton way of life. Okay, so that's how we worked it out. But it was very rough at that time. And now Stefan Bringezu from Germany, he's also one of the founding members, and he's like absolutely passionate about getting the IRP to agree to a target. But there's serious resistance to that. And because it's just going to be incredible. I mean, like in the US, 35 to 40 tons per capita going down to 6 is very difficult to imagine. Okay? So then what Hickel and et al. Then did say, what's the monetary value of this overconsumption using the trade in value add method, TIVA, and how do we price this material consumption of southern resources? By which prices do we use? So do you use the actual prices that were paid to the South for the actual goods that were bought and consumed? If you do that, then what you are saying is that the power relations that result in those low prices in the trade negotiations, so on, are okay. They're an acceptable reflection of market dynamics. And so we're going to ignore them. And so those are the real prices. Or you can say, well, let's price those resources in terms of the prices of those resources in northern terms. So that use that level. So they give both those numbers. And basically it's 242 trillion is the value of that 24% of northern GDP. So in other words, 247 is the price of the unequal exchange. And then if you say what value is that of the northern GDP, it's 24%. And it's roughly a similar quantum of what's being lost from the south. So because of the new material, because of the new databases on raw materials, on land, global raw material, global land, global labor, global energy, you are able now to do these calculations, which wasn't before, even 10 years ago, you couldn't really do it. So I think it's important to then correlate that with capital flight out of Africa. And this is another book published in 2022 by Indy Kumana and Boyce, which is about capital flight out of Africa. Now, capital flight is what is creamed off the top of the resource transfer. So it's actually the illegal component of the resource transfer transactions. So if you don't know what I mean, just imagine you are selling 10 tons of timber out of Gabon to China, let's say, through a middleman. What the middleman will do is provide an invoice to the local Gabonese timber trader that is higher than the actual value. And the difference between what the middleman gets paid and the amount that is paid gets divided up between the people involved and put into a Swiss bank account. That's what I mean. It's the over invoicing scenario, and there's many other. This book tracks all the different techniques that are used in places like Angola, South Africa, Ivory Coast, etc. So they've calculated what the total out of Africa capital flight is. So between 1970 and 2014, it's 2 trillion. They say, okay, it's in tax havens. Let's assume interest rate it's worth 2.4. Between 1990 and 2015, they compare that to ODA, Overseas Development Aid, from the north to the south, which was 2.6 trillion. And 2.6 trillion is 3 times greater than total African debt in 2018. So if that wasn't stolen, because it is stolen, there wouldn't be any African debt. And whenever you go to any, I was in a discussion just 2 days ago of a whole bunch of people from different African countries, and that we're all talking about this famous deal for South Africa, where the donors are saying we're going to give you $8.5 billion to kind of help you with your transition, and all the other Africans are saying, how do we get the same for us? I said, well, actually, this is not such a good idea, because the underlying assumption of this is that we can't generate our own credit from our own financial institutions. We have to get the credit from banks in the north, and we have to pay them back in foreign currency. Why don't we just rethink our own financial institutions? And this was like a completely new idea. But the reproduction of debt is seen as the cause of underdevelopment. So coming back to the financial system, so just now thinking of this as a financial system. In transition theory, so sustainability transitions theory, which originates in the Dutch School of Transition Thinking in the 90s, because of a massive funding program from Dutch government. It's now become an international community of scholars, and we all implicated in November in a conference, the IST conference, the International Sustainability Conference. I think it's the 14th year. There is a handful of articles in this. I mean, it's got its own journals now. There's the generation of hundreds of articles every year. On sustainability transitions, there's probably 5 or 6 articles on finance. And the most influential one that's just recently been published by Geddes and Smith basically says we need to understand finance as its own regime, its own system, in its own right, with its own basic laws. So just like this whole transition theory has developed institutional, technological governance ways of understanding transitions, all those basic rules apply to the way the financial system works. So if that's true, how does this system work? What are the dynamics of this system? And so what the paper then goes into and making the link to unequal resource exchange via capital flight and other arguments. How do we understand the financial system, and what does financialization mean? So, as I've already said, this is how we can understand 625% of GDP in 2020 compared to 30 to 50% of GDP in the 1960s. Since and all of you know this story well. Since the 1980s, trading has grown faster than trading in finance has grown faster than exports and imports. Trading in commodities faster than production of commodities. Capital flows between countries faster than. These are all just indicators of what we mean by financialization. In short, GDP growth rates have become driven more by finance than primary or secondaries. And the question is why? And I think it's in that context that we need to understand the kind of three big flows of cash through the global financial system. After the 1973 oil crisis and its resolution, in quotes, the massive buildup of petrodollars and the oil-producing countries, which landed up in Western banks, which effectively financed the first phase of neoliberalism in the 70s and 80s. Then you have the rise of China and the deployment of Chinese surpluses through government bonds mainly, which then gets lent out through the banking system into real estate, and we have the real estate boom in the 90s and 2000s, which ends with the subprime crisis, and then post 2007, you have QE, quantitative easing, where essentially central banks print money, buy assets, expand their balance sheets. And so that's also starting to peter out. That the Chinese money is more or less no longer there. So the question is, where's the next major flow of cash through the global economy going to come from? And my worry is that it's going to come from the intensification of unequal exchange. That's my worry. And that's going to result in more and more proxy wars, more and more violence, as the competition for resources. And the question mark is Ukraine the beginning of that? This is basically just a resource war. So it's not a very nice thought, but I'm really worried about where the next level of exploitation comes from in order to keep the global financial system running, ticking over. So the legitimizing premises of the system is essentially the notion that economies tends towards equilibrium rather than to disequilibrium, that banks are merely intermediaries. They take money from depositors and they give it to lenders. So they don't create money. Inflation is the real enemy. So use interest rates to beat inflation through monetary policy, i.e. central banks. Development is, so now from a global south point of view, you don't have savings, shame. You need to borrow from elsewhere. What that means is that you're basically taking money from foreign banks, you have to pay them back, and you get locked into the debt cycle. But you need to be attractive for that, and you need to do the usual neoliberal stuff, privatize, decentralize, deregulate. And then the financialization of GDP, which has been written up by a very useful article by Essa, which is really about how financial transactions got incorporated into the definition of GDP in the 90s, even though finance has never been associated with productive value. So once finance could present itself as actually contributing to productive value, it has a legitimation, has a fig leaf to say, don't worry, we're actually doing good things. So obviously that whole system creates a lot of inequality, especially in the heartland, which is where we are now. And you know, the kind of absolutely extraordinary explosion of inequality, and not just in the heartland, but everywhere, is well known. What is not so well known is that the linkage between financialization and the resource question is in commodity trading. So commodity trading has always been there. There's always been a relatively small group of companies that have, over the last 100 years, been dominant in the trading of commodities. It's 2 or 3 companies in each of the major resources. Oil, even oil, is just 3 or 4 companies that do the trading. A South African company called Gencor, 50% of all zinc is traded by them, etc. So I don't have the numbers here onto my fingertips now, but it's a small number of companies. However, I mean, that's bad enough. But they've been transformed over the last 10, 15 years. They've been financialized. So what that means is they trade, obviously they trade in commodities, but they also trade in the derivatives, which are financial instruments, futures issues, or whatever, various kind of that are premised on the value of these commodities, most of which have not come out of the ground. So you can issue a future on a pile of zinc that has not come out of the ground. You can create a piece of paper and you can trade it. And it can go up in price, way above the actual price that chunk of zinc will ever be worth. And a significant portion of the profits of these commodity traders is derived from this trade in futures. So here's just an example from the London Stock Exchange, Metal Exchange, sorry. The relationship between futures and actual commodities in 1982 was 40-1. And there's a role to be played for futures because you're trying to hedge price fluctuations. But that had gone up to 2001. And there's really no real case to justify that ratio. It can't just be about hedging. It's obviously about speculation. So this is, in my view, going to be quite a shock to the International Resource Panel, to say to them, actually, the link between the financial system and the resource system that you are so committed to seeing becoming more efficient and decoupling from is actually managed by a small group of companies, most of them headquartered in Switzerland, who have become increasingly financialized. So you have to address this question. So the finance and the transition itself. So climate finance is on the increase, according to the Climate Policy Initiative. The target, according to UNEP, should be about 4.5 trillion. The actuals by 2020 were nearly 650 billion. Adaptation is the poor relative. 46 billion in 2019-2020 should it's an increase on the previous year, but according to UNEP, it should be 155 to 350 billion. The IMF has calculated that ESG-related debt is rising very, very fast. There's 4,000 signatories of the principles for responsible investment. And there are 450 asset managers from 45 countries controlling $130 trillion who signed the Glasgow Financial Alliance for net zero. So this is the story in all the kind of mainstream fora where finance people get together and say, yeah, obviously we are committed to financing the transition. The question is it true? So there's this is published in Nature, 1.8 million companies own 43,000 oil and gas assets, most of them OECD shareholders. This is Giles' work with others. 11 of the biggest EU banks own 520 billion euros of fossil fuel assets, 95% of their equity. 60 of the world's biggest banks invested 4.6 trillion in fossil fuels assets since the signing of the Paris Accord in 2015. So there's a lot of greenwash. The reality is capital is not really fundamentally being reallocated. So the UNEP problem statement is still there despite the greening of the language. However, there are some new trends. And when I refer to these new trends, I'm not saying that these are new trends in the right direction. There are shifts in the structure of capital since 2007, in the flow of capital since 2007. One reflection of this is the rise of the index funds. Index funds are asset managers. They manage assets for others, and they invest in stock exchanges around the world on behalf of others. And for that, they take a fee. That's their business. Okay. The index funds don't make mental calculations of what to invest in. They have algorithms. So these algorithms hunt. They're literally hunting packs of algorithms that get spread out across the global financial system, across all the public stock exchanges, and automatically take options on kind of buy up shares in stock exchanges around the world. As a result, their fees are very low. Because their fees are low, there's been a massive flow of capital into index funds since 2007, from 3 to 15 trillion. The projections are, some projections are that the three big ones, BlackRock, Vanguard, and State Street, will have 34% of the S&P 500 by 2028, which is absolutely gigantic. Now, the argument, the positive argument, which has come out of the Stockholm Resilience Center, is this could actually be a good thing, because these institutions have now an interest in the health of the global economy as a whole, not just in a particular company or a particular sector. And so and that's the explanation for the Larry Fink letter, which went out to the CEOs that they invest, saying, listen, guys, the global financial system is changing, climate change has to be faced. We're going to be putting pressure on you. The actual empirical research into how BlackRock representatives on boards vote doesn't bear out his letter. But I think it's significant. It's a redirection of massive quantities of capital into these algorithmic funds, and it's a shift and the construction of a new set of players. There's also been a significant rise in sovereign wealth funds. Sovereign wealth funds are state-owned funds into which you put resource endowments. So Norway is the biggest one. The Norwegian Sovereign Wealth Fund. Oil money goes into there and then invests around the world in order to kind of replace the value of the oil, which no longer is there, into value of capital. So the sovereign wealth funds are mainly in Middle East and Asian, but as I said, Norway is the biggest one. And over the last 2 years, have all more or less shifted into adopting climate change covenants of one kind or another. How true that is, there's an association of sovereign wealth funds for climate, and they have meetings and conferences, and so yeah. But the Norwegian Sovereign Wealth Fund, a study was done for the Norwegian government that said that the Norwegian Sovereign Wealth Fund, which is invested in 9,300 companies, should start divesting from those companies that are fossil fuels. And then there's the DFIs, the development finance institutions. There's 527 in 150 countries, 18.7 trillion worth of assets, which has tripled in size since 2007. So although DFIs have been around for quite a long time, they actually got their big boost with the Bretton Woods conference. Obviously the biggest DFI is the World Bank, but there are lots of DFIs at regional level, like the European Bank for Reconstruction and Development, and then there's DFIs in different countries. There's even sub-national level DFIs. And they went into decline in the 70s and 80s, and have now, especially since 2007, have kind of rocketed. And now there's also an international club of DFIs, the International Development Finance Club, as it's called. I think it's 27 members, 30 members.
30 now.
30, yeah. And then the central banks, especially because of QE, their balance sheets have massively expanded. So 38 trillion by 2020, also massive growth since 2007. Adam Tooze has argued that their mandate has shifted from fighting inflation, their original logic, and the reason why they kind of colonized, if you like, monetary policy, to monetary stimulus, to kind of rebuild economies in the wake of weak or inadequate fiscal policies that were not stimulating enough. So rising interest rates has got a lot to do with what's happening in natural resources. But Mark Carney, when he was a governor of the Bank of England, initiated a whole process which has now become a global movement, and has resulted in a new association. I've forgotten the name of it. Something like I don't know, I can't remember. It's kind of an international association of central banks for climate change, and they're all kind of copying, including the Reserve Bank in South Africa, the method that he developed, which was kind of scenario analysis, stress testing, and various other instruments to kind of position the central banks for preparing the financial institutions for the shocks to come and how to adjust. So that's the rationale. So just to end off with a kind of going back to the conceptual framing of how we think about whether the financial system is fit for purpose, I find this, I've adapted this work of Stephen Spratt, who used to be at Sussex, who made this distinction between green and red, and basically red is basically the just transitions, social commitment, and green is how far down on decarbonization and resource efficiency and biodiversity. And that gives you this quadrant of light green, which is what you could call fit and conform. No real fundamental changes, but you finance kind of light green transitions, not much social justice. DFIs maybe would push you down a little bit further into the red, bit more social stuff. You might, at a stretch, go a little bit into the dark green, more fundamental decarbonization. So what's been recommended for the Norwegian Sovereign Wealth Fund actually is pushing you into that direction. Get out of fossil fuels entirely. There's not much social there, so it doesn't go down. So the kinds of players that are in here are few and far between. That's where the just transition. So South Africa was the first country to put just transition in its NDC, and now everybody's got just transition in their NDCs. And the question is, how do you, which financial institutions actually are fit for purpose to fund both deep decarbonization and greater social justice? That is a massive challenge for most of those institutions. So to end off, can you democratize capital allocation? There's going to have to be campaigns against unequal exchange based on the new data that's available. My luxury is your suffering. Support for global South countries in trade negotiations to rectify the imbalance. Clampdowns on capital flight, of course, which is a global South challenge, governance challenge. But there are the enablers. So we have an NGO in South Africa called Open Secrets, and they continuously publish reports on the way in which consulting companies like Deloitte, PwC, etc., McKinsey collude with financial institutions in facilitating what is effectively illegal transfers. An activist interventionist role for banks in restructuring the banking sectors. Richard Werner says gets rid of central banks entirely. He thinks that no matter what you do, they're bad. Expanded role for DFIs. including a return to the original mandate, which was not just dependence on capital markets, but also finance from governments. Expansion and reorientation of sovereign wealth funds. The index funds should actually get their nominees on boards to behave. A new proliferation of community, non-profit and cooperative banks. And I've been reading quite a lot about the French cooperative banks and the cooperative banks are in Germany, but the French also have local banks. So those systems, the re-regulation of commodity traders, they're just out of control. They're just a bunch of gangsters, and they just have no right to exist, actually. Divestment from fossil fuels, fine, but you need a solution to stranded assets, and that's where Loribel's work is also useful. I have never had the courage in South Africa to say our central bank should buy up the stranded assets, but maybe at some point I might. Resource nationalism in the South, in other words, don't let your stuff get stolen, even though you might get a bribe, and the definancialization of GDP. Those would be, in a sense, elements of a program. These are the references.
Thank you very much.
So hopefully we can discuss.
Yeah, I don't see any questions online, so while there are maybe people who ask something, we can ask people here. So if somebody has a question.
Can we see the numbers of people online?
What's on?
Can we see the people online? Is that possible?
I don't think so in that system we have now. When it's for today, I think we can just see the panel. But it's just the panelists and the host.
Okay.
The last slide.
I have to reshare, okay?
Hello, Swilling and Diana.
Yeah, then they can talk. I didn't do the system with Zoom. With Zoom, it's like the whole thing, and it's separating the panelists and
This one.
Colleagues from South Africa also join us.
So does anybody have a question of our remark or?
Yeah, I mean, a lot of things for everyone. Maybe I can start. So I think it's not really what you said. It seems to me there is one very important thing, which is the French, which is the French colonies. The French also wasn't part. Well, you have 11 countries. So there are two.
How many?
11.
11.
Two French cantons. And there is a hard debate about whether they should not have a sovereign currency. So the leader of this debate is Catholic, whom we could invite directly. He's a former perspective in Togo, who's in Cameroon, originally in Cameroon. And then if they succeed in setting themselves free, they could take this opportunity to ask their own central banks to create money for them, so that they no longer rely on borrowing money outside. Because once they make this big jump of taking themselves free from the French old colonial system, they might go further. So maybe there is a big overlap. I mean, it's a big political party, and I'm sure that France is playing here. But this might be a place where they might try something. At least I think we should discuss with them. And tell them, if you do this, let's do it in the right way. They all face big challenges, climate change and natural resources. So they're all concerned by all this. We have agriculture, so this might be a big opportunity. Maybe another comment is that regarding the DFIs.
They're saying they cannot do it.
Oh, sorry.
I think
Oh,
we
maybe
are
I should stay here.
same for my
Can you hear me if I come here?
Perfect.
Yes, okay. No, I was just saying, it was a comment on the fact that there is a big window of opportunity now, opportunity window linked to the fact that you have the French franc zone in sub-Saharan Africa, which is challenged by a number of people. And if these countries succeed in setting themselves free from the old colonial French franc, then they might also as well go further and ask their own central banks to print money for themselves. Instead, as you said, Mark, and as Werner says, actually, instead of relying on borrowing money on international markets, which increase their debt, etc., and therefore their dependence towards the north. So this was the first point. And the second point is, regarding the DFIs aspect. So there is this big hope that DFIs might play a much bigger role. One of the difficulties is that now the biggest player is no longer the World Bank, but the China Development Bank, the CDB. And the CDB obviously has a political agenda, which makes the whole situation much more complicated. The CDB is trying to compete with everybody with very low interest rates, huge amount of money, especially in Africa. And this makes the life of DFIs much more difficult. So yeah, there is this hope that the International Finance Club, Development Finance Club, IDFC could play a role, and they could. And nevertheless, at the same time, there is this huge complication induced by the role of the China Development Bank. Yeah.
Two questions. Yeah, thank you. You have to wait for that. What did I want to ask? And you have like 5 minutes.
Okay.
Answer.
Okay. No, just to be trying to be concise. So first, I agree and thank you for all those points, because like it's quite extensive and like it's a very good global view on the situation. So I really appreciate. The first, I will try to be chronological. The first one, which you were talking about non-material growth of economy. Do you have like, personally, I feel stuck on that because I see no way an economy can grow without material growth. Do you have any theory or articles that can go into that direction? Because what we see is you can do weak decoupling, but strong decoupling is big of an issue. So how do we do that? And does has the North need to degrowth in order to find a sustainability into all of that? Because we know that obviously the South has to grow. That was first question. The second one, which is kind of again about degrowth, is we know that we need to definancialize GDP. So we need to reduce the part of finance, and so we need finance, and we need to reduce and to have a degrowth of finance. How do we do that, and how can the people that can control what is happening on the financial market can be convinced that such things is necessary? You are, as you've seen, the bigger the crisis and the bigger the problem, the bigger the market, because we think in market. And no, the market are so big that they are too big to fail. How can we reduce them in a way which is not producing a failure of the market? Because we are creating this monster, and it's a bubble, like the whole market's a bubble. So how can we go like this? And do you have ideas of how to see which part of the new redirection of finance is truly allocated to a pure willingness to go towards sustainability, and which parts is just that green investments will just have a better rentability because of the problem stranded assets?
And you have any minutes?
Yes, there are so many points to see,
Yes,
because like it's
absolutely.
open in a galaxy of opportunity.
Yeah, but I mean, that's the advantage of opening the conversation. And I mean, you have the conceptual wherewithal to kind of see these things and, run forward. Imagine what might happen when you present a story in a room of UN country representatives, government representatives, plus academics who are not exactly sharing your view. So how do they absorb this? How do they relate it? And you know, the danger is they just look at you and say, you're not qualified to talk about these things. That's how economists tend to. They look at you like you got chicken shit on your nose, and they just get out of the room. So on non-material growth, I'm not sure about it as an absolute statement, but just a couple of ways in. If you know the famous diagram of Human Development Index versus ecological footprint, where if you look at the Latin American countries that are actually reaching high levels of development, like Chile, they're not up there with the European cluster, up the ecological footprint high on HDI. They're actually relatively low. Marina Fisher-Kowalski is now running numbers which show that the amount of material resources required to reach an acceptable level of HDI is systematically going down. So those two kind of correlate with each other. But I tend to think of it much more. I think about it in a very different way because of my background at cities. So there's a lot of cities with genuinely progressive mayors who are trying to think about what is not just decarbonization, but dematerialization or non-material growth look like in a city. What are the material implications of 100% renewables? What are the material implications of getting rid of privately owned vehicles? What are the material, like in Barcelona, banning Airbnb? What are the material implications of densification, which is might not be a big issue in Barcelona, but it's a big issue in Atlanta or Johannesburg or Cape Town. What are the implications? What are the material implications of in African cities where you might have 60% people living in informal settlements, having an urban development strategy which is not suburban, well, it's not a suburban solution, but a multiple, 5 to 7 story solution. So I think but it's not absolute. So it's less material economic growth than non-material economic growth. So yeah, I think that's a big challenge. On the question of finance, I mean, I'm not sure if I caught you correctly, but you talked about how do we create a crisis? I think it's creating itself, so especially if the Chinese financial system starts to, so many people are talking about that bubble bursting. If that bubble bursts and we go through another major financial crash, who's going to pick up the pieces? So Milton Friedman had this great phrase, which was, after a crisis, it's the ideas lying around that get picked up as the alternative. And for them, it was the neoliberal solution, and Montpellier society, and so on. So my question would be, who's assembling the pieces that then become the basis for a different imagination? I think Mark Carney, with all his contradictions, is actually one of those. Adair Turner, who used to be the UK Financial Services Board, director, is very much along those lines. And various, Giles, various others, I think, are starting to connect some of the pieces around what an alternative system looks like. I'm trying to set up a conversation within the World Economic Forum, a partnership between the World Economic Forum and the IDFC to say, let's start having the conversation now in anticipation of a crisis that's going to have to result in an alternative architecture. I completely agree with Gail around Africa. Africa has leverage. I think if the African Development Bank and Africa networks could actually get around the idea of getting rid of the CFA, getting rid of the assumption that if, oh, we don't have savings, therefore we must borrow, get rid of that assumption. Bring the African financial institutions together, which is, I have leverage for another year or so to be able to do that, and say, let's present a different picture of ourselves as African financial institutions. If you do the audit, the DFIs, the private banks, the growth and venture capital, there's all sorts of things happening on the African continent. But if you don't join the dots, they all have their own linkages to international flows of capital, which is just another way of seeing the outward flow. What happens if Africa, with all its resources, especially the resources required for the energy transition, say, no, we're not going to play the game anymore? I know this is maybe romantic thinking, but it's what I'm trying to do. And we all do our little bit in a little way. I mean, the stranded assets issue that Guy's been talking about. If we don't have a solution to stranded assets, these financial institutions are literally going to go to war. They will fund, in one way or another, defense of the system. And that's going to be nasty. It's going to be very ugly.
I'm sorry, I have to have the value of 15 because we are already out of time. But thank you very much. I think I'm not hearing me
online. Now, yes. So thank you very much again. And we'll see all of us next week with Dr. Jose Alberto Lara Pulido with a talk which is entitled Economic Valuation of Ecosystem Services and Social Cost Benefit Analysis in Mexico. And I look forward for that. So same time, same place, and I will send you the links and the form for registering if you want to come here by email. And if you are not on our mailing list, reach out to me and I will add you, so you will have everything for the next seminars. And that's it, I think. Thank you very much.
Thank you very much.